This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
All right. Well, welcome everybody.
Yeah.
I see Rod's got his Frappuccino cappuccino ready to go.
This is
I've got my
right? Because we're supposed to be drinking, no?
I've got a Johnny Carson coffee. You'll notice that there is no steam coming out of that coffee cup.
All right.
I feel like I'm in the middle of some very strange in-joke here, but so maybe someone explain it to me afterwards.
You didn't know Johnny Carson, his coffee cup? He always had a coffee cup. That thing was filled with whiskey every night. That's why there was never any steam out of the old coffee cup in the Johnny Carson show.
You learn something new every day.
There you go.
Okay, let's introduce our guest, Rob Carver. Welcome to Resolve Riffs. Thanks so much for coming on. And I note that you are broadcasting from your man shed, right? You had a great series where you sort of showed pictures and stages as you went along. You sort of built that on your own, or at least had something meaningful to do with the construction of that, right?
Yeah, so I built the base myself, and the thing comes essentially as a load of pieces of wood that you have to kind of hammer together. So I did all that, and then I had to kind of do all the finishing and the painting and all that kind of stuff. So yeah, so probably 2 solid weeks of work, I'd say. For someone who was competent, it would have been a week, but for me, it was 2 weeks. Also, doing everything by yourself is not. Oh. It says recommends 2 people, but
yeah.
But I
thought, you know,
is it like an IKEA shed where you get the parts and the assembly instructions?
It's similar-ish, except it's not from IKEA, and you don't end up with like 78 sort of little screws left at the end, and you've no idea where the hell they go. So fortunately, I didn't end up in that situation.
That's kind of neat.
But it's great, and you showed the view, and you look out onto this sort of garden, this bucolic scene, which I'm sure is inspirational and calming as you're sitting coding and riding your makeshift Peloton in the background.
Yeah, it's quite nice. The only downside is we have a lot of squirrels in our garden, and I'm kind of deep into a function trying to debug it and like really concentrating hard, and then this little rascal will kind of run across my roof, and it sounds like someone playing the drums. So that's the only distraction. I realize this is like a real first world problem now, because a lot of people over the last year or so, obviously working from home brings massive distractions. But I'm fortunate that I built this in the summer of 2019. So when it came to last year, and I found suddenly that my children were home the entire time. There's a good 150 feet between me and them at all times. Now they're back at school, it's less of a problem. But certainly last year, having this little refuge was very, very nice for me.
Oh,
and
life-saving.
Probably life-saving for them as well, to be honest.
Yes,
I bet.
Agreed.
So Rob, I think it's useful.
Well,
before
we start, just everybody realize this is for entertainment purposes. So take neither any construction advice nor any investment advice from any of the scalawags on this call. Yeah. And just leave it at that. But go ahead.
Yeah, no, I just wanted to sort of introduce Rob, or maybe Rob, you can kind of give us a little bit of your backstory. I'm sure, I always find it funny bringing guests onto this show who are much better known than we are. And then, assuming that people don't know the guests and somehow know us, but I do think it's useful for you to give us a little bit of your backstory. And then I want to talk some about your books, specifically Smart Portfolios and Systematic Trading. We may get into leverage trading. a little later on. But yeah, maybe just your career trajectory to get us started.
I'm not sure I'm better known than you guys. If I am that, that's a serious crime, because your output is extremely good, and I think it's generally accepted that most people who are trying to sell a fund and also putting out research, that the quality of the research is not very good at all, right? Because it's often purely a sales exercise. And I'm not going to name names, but it's fair to say that you guys are in a very small group of people who are trying to sell a product, but also putting out research out there that's extremely high quality. So, but anyway, enough mutual appreciation. I'm sure people didn't sign up for that.
Did you say mutual information? Wow, we're really getting into it quickly.
Okay, where was I? Oh yeah, so me. Okay, so I've been trading probably for over 20 years now. Professionally, I started trading on the sell side for an investment bank in 2002. I did a couple of years with them trading exotic interest rate derivatives. And then I spent a couple of years in economic research, and then I got a job with AHL, which is a large systematic quant CTA based in London. And I did a couple of things for them. I started off with a new kind of product, which was basically a systematic kind of global tactical asset allocation type product, which is very different from what they're known for, which is kind of trend following mainly. So I did that for a few years, and then there was a business restructuring, and I was sort of promoted kind of, I guess, sort of a bit up and a bit sideways, so diagonally, to be head of fixed income. So that was running all the fixed income risk. So, bond futures, interest rate futures, interest rate swaps, credit default swaps, mortgage bonds, you name it, all that stuff. And I did that till 2013, and then decided I had enough of working for other people, and I was in a fortunate position where I didn't have to anymore. So I left them, and the last few years I've done various things. So as you've said, I've written 3 books, 2 basically on trading, 1 on investing, although there is a bit of investing stuff in the trading books as well. All about doing things systematically, so using systems, using methodologies. So none of this kind of looking at charts and looking for inverted vipers or any of this stuff, or any of this kind so purely rules based.
Vomiting camels.
The vomiting camel,
of course. Yeah, which. So none of that stuff, but so stuff that the way I like to describe it, it can be coded up, but doesn't necessarily have to be coded up. And in fact, my long only portfolio is run using rules, but not without any automation. I just do the trading manually myself, and it's quite low frequency, so that's fine. I'd probably trade that once a month. And then I've got a systematic futures portfolio that's a pure, fully automated kind of, that trades just futures. So I obviously do my own trading, although mostly I'm not trading. Mostly I'm writing code or doing research and all this stuff that leads to ultimately the computer doing the trading for me, mostly, apart from this once a month rebalancing exercise. I do a bit of teaching at university, as we were talking about. I did a lecture this morning, which is why I'm dressed relatively smartly for me. My normal pandemic kind of workwear is obviously a lot more casual, like most people. So that's what I've been doing for the last few years.
That's fantastic. So actually, if you'll indulge me, I'd love to get a sense for when you arrived at the conclusion that systematic thinking was the right approach to markets, because I think I certainly came to markets with very much a discretionary view, and I try to sort of be figuring out the macro dynamics and trading off those themes. And it took a couple of frying pans to the face before I realized that systematic thinking was really the only coherent approach to complex systems. But how did you walk that journey?
It's a weird one, because so my first exposure to the industry was when I was still at university, and in my penultimate year summer, I did an internship actually at AHL, although I didn't subsequently go on working for them after I graduated, which is another story entirely. So that was my first exposure to the systematic industry. That was actually my first job effectively in finance, completely in finance, although I had done a bit of PA trading before that, with a very small amount of capital that I had as a poor university student. So I kind of, that was my first exposure to and that seemed like a very logical way of doing things. And at the same time, I read a book by a guy called Thomas Bass called The Predictors. I don't know if you've come across it. I've mentioned it a couple of times in interviews before, and I'm surprised by how few people have come across this book. But it's a non-fiction book, and it's a book about a hedge fund called the Prediction Company, which was subsequently bought by O'Connor and then by UBS, run by Doyne Farmer, who's one of the kind of, and some other people, but he's the most famous, who's one of the kind of leaders in sort of chaos theory, and he's now teaching at Oxford actually. But I read that book, and it was a very, very well written book and very interesting, and it made it sound like a kind of I don't know. It's something about when you're trading systematically, it's less it's more structured and rigorous, but it's somehow cooler to someone like me anyway, and more fun because you're not having to, the kind of thinking that you're doing is completely different from the kind of thinking you're doing when you're making trading decisions. So when I was working in a bank, I did not enjoy that at all. And I was working actually in a relatively difficult part of the bank in terms of the fact that we weren't just buying and selling, say, spot FX. We're pricing complex derivatives. So it was quite a mentally challenging job, but it was an intellectually stimulating job. So it was like, the best description I've given is that imagine that you've been told to solve Sudoku puzzles while 12 fat guys are yelling at you. That's what it's like. To me, that's what working on a trading floor was like. And some of them weren't fat actually, but the physically intimidating people, right? So that was that. So I had this kind of brief exposure to this really nice, interesting, fun industry called systematic trading, and then I had 2 years of hell in an investment bank doing the discretionary trading. And then a couple of years later, I got back into systematic trading, and it was just like, I mean, at this point I was, I guess, how old was I? I was probably, I was like 30 years old or something like that. 32, I think I was 32 years old. And it was just like, this, I felt like coming home. It's like, right, this is the industry what I want to do. It suits my skill set. I not understand why most people choose to trade within a discretionary fashion, because it's something that's superficially appealing and interesting and cooler. And let's face it, no one's going to make any films about people doing our job. You can't really see, I don't know, Tom Cruise like leaning over a computer and going in that Tom Cruise voice, guys, I think the algo is broken. It's not. There's no drama there. There really isn't. It's not sexy. It's not cool. It's not interesting. But to me, it's actually it is cool. It is interesting. It is sexy. It's intellectually interesting. And yeah. So for me, it wasn't one of the. You sometimes hear of people who start trading in a discretionary fashion and gradually come to realize that systematic is better. And I guess, Adam, that's kind of maybe your story. You hear that a lot, but for me, it was more a case of actually, it was just a kind of blinding, obvious. This is the way you should do it. Now, the more interesting thing actually is, while I was working at AHL, if you look at my personal account trading, which obviously was limited by compliance restrictions and that kind of stuff, it was extraordinarily unsystematic. It was my individual personal portfolio was a complete mess. And that's because I had two problems. Firstly, I didn't really have time to kind of think about that. I was worrying about my day job, which was obviously more important. But also, I was exposed to this constant flow of market news and ideas. And I'd be like, there's this stuff on the street about this stock. Well, I'll buy some of that, or some of this, or some of that. So I actually I ended up massively over trading my own personal portfolio. And it wasn't until I actually retired, I kind of sat down and looked at the spreadsheet with something like 120 tickers on it, and actually then began to piece together a way of trading this systematically using, ironically, all the skills and knowledge I already had from my day job.
So that's an interesting backstory. When you talked about the 25 traders yelling at you while trying to do the Sudoku method, you mentioned that you didn't quite like that, even though it is, I would imagine it's more like the mathematical problem is kind of a solvable problem, but you have a lot of emotions involved in the trading of that to the market. Is that what you disliked about it? The fact that it was emotional?
I mean, there wasn't really time to think. Like, it was the ironic, you had to think kind of a certain way and do a certain thing, which is basically had to think very quickly under pressure to solve problems that were sometimes quite complex. Often, the thing I actually found fun was the fact that, okay, you've got 10 minutes to price this trade. There's no way it's a new kind of trade. We've never priced it before. There is no way you can get a quant to go away in a room for 6 months and come out and then with a French accent, because all the quants we employed were French, say, this is the most elegant, perfect, optimal solution with all the factors considered. You had 10 minutes and all you could really generally do was glue together two different spreadsheets and price something that was probably 99% correct. And hope that you hadn't missed something that would end up blowing up the bank because of some unforeseen risk. So actually, I found that quite fun, but it wasn't really giving you time to actually think deeply about. I didn't feel I was actually developing any trading skills, really, to be honest with you, because there wasn't the time to actually think about the markets, think at a more strategic level. It just wasn't there at all. This is the thing. The ironic thing is a lot of people want to work on trading floors and investment banks, right? I mean, maybe not so much now. It's not such an attractive job, but certainly 20 years ago, it was a job that, 30% of my graduating class wanted to do. And I was the guy doing it, and I actually hated it.
Yeah.
And now that you're trading your PA account and systematize it, is all the emotion gone, or are you still doing it? Are you still feeling the feels?
Okay, that comment deserves sharing. Keanu Reeves isn't going to star in the covariance matrix.
That's
magic.
Some good stuff.
Brilliant.
Good.
Well done.
Cheers to Matt.
You, Matt.
Ani, you're not going to show that comment. Come on, let's put that comment.
I'm sorry to interrupt the flow but it's too good. That's
fine. It's too good. Actually, if any Hollywood producers are watching this YouTube channel, I'm sure there are probably a couple. There is a very good book by called The Fear Index, which is actually about a guy who works in a systematic fund, unbelievably. And it actually is a very good book. It's a real kind of thriller, exciting thriller. And so there is a film there potentially in that book if someone wants to make that. And I am available as a script consultant at my normal rates, of course.
Oh, dude, we want you as a leading man.
Amen.
Perhaps not. I don't think it would be as marketable. I still think maybe Tom Cruise or Keanu Reeves would do better. Back to your question, which I haven't forgotten. Emotion and trading. I mean, it's still true, actually. I mean, even yesterday I was rebalancing my portfolio, and I actually made a mistake. So a couple of days ago, I bought too much of a particular fund, and I was still. Because it's just after the end of the UK tax year, so I have to do a bit more rebalancing than normal. And I went and looked at that. I bought too much of this. I really ought to sell this down, and then put it into the fund it was supposed to go in to begin with. And I got some other stuff to do as well, so it wasn't like correcting one mistake. And I looked at that, and the price of the ETF had dropped by like 2 cents. For a loss that, as a percentage of my net worth, is insignificant. Could I pull the trigger? Could I take that few £100 loss, which also actually in a way is a good thing because it was in a taxable account, so it was a tax loss. So actually it wasn't all that bad. And I was actually it was about half an hour of me sitting there going, maybe it'll go up, maybe it'll just go up a little bit, and I'll be able to close it. And after half an hour, I thought, this is what the. I kind of got a copy of one of my own books and I beat myself over the head with it until I was sensible, pulled the trigger, closed the trade, took the tiny loss, did the rebalance correctly. But so yeah, even I, after all these years, still, the emotion's still there. It's very hard to get rid of.
I thought your forehead looked a little flatter today.
Yeah.
Pulling on that thread a bit more. It's the Kahneman
thread. Go ahead.
Pulling on that thread just one more time. I know there's a chapter in your book where you talk about having thought systematically about purchasing stocks when you're in a panic, and you talk specifically about 08. I would love to hear that story again and share it with the audience. And then the follow-up to that is, how'd you do in the COVID crisis?
So the story is basically that it was actually Q109, and it felt to me like we were at the bottom of, we were at the bottom. And I thought, well, where is the best place to put my money? In the UK, banking shares, because they've been just massively beaten down, as you would expect in a debt and leverage crisis, of course. And Barclays, and also I understand banks as a business, and I can read the balance sheets and stuff. Whereas if you were to ask me to do that with an insurance company, I would struggle. So I thought, well, I'll buy shares in a few banks. The biggest share would have been in Barclays because I felt that was in the best position. And as it turned out, they raised money privately rather from the government. So that subsequently was obviously the case. So the point to make here is, it was a discretionary trading decision, but actually it was a good one. The problem is that when it actually came to pulling the trigger, I panicked. And my timing was perfect. I probably was within like 3% of the bottom, something like that. And I bought the moment some really, really bad GDP numbers had come out in the UK, just astonishingly bad GDP numbers. And the market tanked as a whole. The banking shares sold off. I thought, well, this is not new news. This doesn't change my thesis. I should go ahead and buy these things. And I just could not force myself to buy in the size of trade that I'd originally intended to trade. And I just cut everything in by 90%, and I bought 1/10 of the position I intended to take. Those shares probably went up by something like 350% in 6 months. So the reason I include that in my book is to show that even if you make good trading decisions, and I'm by any means am I someone who makes those kinds of decisions all the time, absolutely not. You still need some kind of system in place to manage your risk and manage your position size. It doesn't matter who, if you're some kind of genius trader, I still believe that is where you should use systems. I still believe most people probably should use systems for everything, including deciding when to buy and sell. But if you do think you can make those discretionary calls, you should still have a system in place to size them.
So that's a really good point, and a point that I think is something that we could talk about a bit more. Jason Josefiak has a wonderful framework, sort of a four-legged chair, if you will, where you're harnessing beta. So and then you've got some prediction that you might want to do, some tilts, and then you've got a bit of a protection side if you want to do some tail hedging, and then lastly there's opportunistic. And this weird opportunistic bucket is really quite hard, because opportunistic can be, as you encountered a particular situation where you had a fairly high degree of confidence that in fact there's a number of things that the models are actually not aware of. Your models only know inputs to the models are, and you as a PM or overseeing your own portfolio do have a wider, more pervasive view of the horizon. So, I mean, can we delve into how you do that? Either with a particular sector that looks particularly good. I mean, this was a banking sector in the middle of a crisis. Great. You could look at, tobacco stocks in 1999. You could look at uranium stocks today after a decade of, just being absolutely obliterated. How do you work that in?
I mean, there's different ways of doing it, and actually, I think another sort of paradigm that's quite nice and is often people say with your, financial advisors say you should reserve 5% of your money for just gambling.
Right.
So for me, I think it's okay to say, right, most of my money is going to be run in this very structured and rigorous way. For most people, that probably means passive, a diversified portfolio of passive ETFs. Yeah, and if you've got enough money, maybe some stocks. And maybe you want to go beyond that into tactical asset allocation and momentum and the stuff I do, fine. But the point is that it's our human instinct, firstly, for two things. Firstly, it's our human instinct to have a bit of fun. I mean, and to be interested in things. And I said earlier, when I was working, in the industry, there's this constant stream of ideas and stuff coming in. So effectively, my entire portfolio consisted of this sort of discretionary, fun, kind of interesting stuff. I wouldn't even go as far as to call it opportunistic. That's dignifying it with a name it does not deserve. That implies, a level of skill and rigor that was not there, with the possible exception of the trade we just talked about. So I think that it makes a lot of sense to say, actually, most of the time I'm going to run my money in this particular way, but I'm going to reserve a certain proportion of my risk capital for things that just come up. And they may be things that are outright gambles, in which case it should probably be quite a small amount of money, maybe 5%, maybe 1%, whatever your risk appetite is, whatever you can afford to lose. It should be money you can afford to lose. There's sort of a link here between that and the kind of Nassim Taleb sort of barbell idea, isn't there? Where you preserve a proportion of your money for kind of out of the money options you think are cheap, effectively. It could also be opportunities, things that could come up, and that depends very much on how much interest and time you're willing to spend on that as a bucket. So it might be that you just keep 5% of your risk capital aside, and every year or so something comes up. Or it might be that you're spending more time on this and actually it's a quarter of your risk capital. That's fine. But the main point is, firstly, it should be a strict proportion of risk capital. You shouldn't just suddenly sell everything and go and buy, GameStop because that's the fun idea that's crossed your desk today. And the second thing is that even within that special bucket, you should still be applying some kind of system in terms of risk management and position management. So
allocate a particular portion. Step one, you've got an opportunistic bucket. You're stating that explicitly. You put a percentage aside that you're comfortable with. I suppose you'd also be able to rebalance that, back to your balance between opportunistic and sort of the other systematic buckets that you might have.
Yeah, I mean, it might not be a fixed percentage. It might. So actually, let me go back to the unanswered question about COVID, because actually that's a really good example. Because with COVID, it wasn't so much the case that I've got 10% of my capital here. I'm gonna put that into a COVID specific trade. What it was actually I have my normal kind of portfolio rebalancing process. But I wanted on top of that, pulling the lever mainly between equities and bonds, although also individually within asset classes as well. I wanted to override that to some extent to reflect the fact that I had basically had an opinion on the likely shape of market movements. So my main kind of input into my sort of long only asset allocation, bonds, equities, is a 12-month momentum signal. I knew that would be way too slow to reflect what was I could actually see happening, like coming in at me at 100 miles an hour. So the way I describe my discretionary trading ability is every 10 years and this has happened twice, so it's probably not statistically significant, but maybe every 10 years, if there's something really big happening, I seem to have twice now been able to catch the top and the bottom of that. Actually, 3 times if you count the tech boom in 2000, although actually I had no money then to trade with, so I couldn't commit to that decision. So what I did last year was in February, I started pulling the handle on reducing my risk, reallocating from risky assets like equities towards US treasuries, and doing that in advance of my tactical asset allocation model. So I basically, let's say my tactical asset allocation model was going from, let's say, an 80-20 portfolio and was gradually moving down. I was accelerating that, but within limits. So I wasn't just, oh my God, the world's going to end, I'm going to sell all my stocks now. I didn't do that. I set myself a kind of a limit. So it wasn't a proportion of my capital that was my opportunistic bucket. It was a proportion of my risk allocation decision. And then on March the 23rd, I had this really strong feeling that we were going to go back up again, that we were at the bottom. I think I was one day out. So again, I accelerated I then switched the risk back into equities. And again, this was going against what my model would have wanted to do, because my model was using 12-month momentum that was still showing, a completely different signal. But again, I didn't go, I didn't pull the handle and go from 0 to 100 in one day. Right. It was a gradual reallocation, but it was just speeding up what the model would have done anyway. So it was essentially taking some of my system, taking that away from the system, allocating that to a discretionary risk management decision, but basically otherwise following all the rules of my system. And the difference between that and 2009 was I felt very confident in what I was doing, because I knew that I was doing it in a size that I knew that the worst case scenario was if I'd made completely the wrong decision, it wasn't going to be the end of the world. I'd underperform what my system would have done anyway if I'd made the wrong decision, but it wouldn't have been dramatic, Conversely, of course, I didn't end up making a lot extra, so I probably made an extra 2% last year from that little discretionary allocation based on my whole portfolio size, which, is better than a kick in the teeth. Yeah. But it could have been a 2% loss, which I would have been okay with.
Right. And it reflects the humility of you're making decisions overlaying your model that are probabilistic, not deterministic, where, the world's going to end, or, the world's going to be okay, so I'm switching 100% back and forth. But it's a bit of a dimmer switch, maybe overlay, where you're saying I'm going to impart some of my experience, expertise, and judgment through the execution of my models. Probably would make sense to have a bit of a checklist. I'll bet you that checklist for you is it's in your bones, because you have so much experience with respect to some expertise and judgment, and having done these calculations so many times, you're very aware of where your models will have some blind spots. Is there any obvious checklist points that you kind of go through mentally in your head when you see these opportunities that allow you to come to these conclusions, or is that?
Again, I feel like I'm dressing up like two lucky strikes as it's like,
of course it's going to go wrong at some point, but if you have another 3 times, and this
is something that's so rare for me that I don't really feel I can tell you, yes, these are the factors I looked at when making this decision. It is, and my reputation's ruined after this podcast, right?
That's why it's live. We do that
it's
every
all
time.
intuition.
Yeah, this particular decision was literally intuition, and I could tell you the things I was looking at, but it was the same thing everybody else was looking at. What made me decide that the price was going to go from on the 23rd of March, whenever it was, and you can check Twitter. I did tweet and say this is the bottom, in my opinion. What specific thing was it I was looking at that made me think this is the bottom? I couldn't tell you. Honestly, couldn't tell you. And I think the main lesson from this story isn't that Rob is some kind of genius picker of market tops and bottoms, and this is the secret checklist that he uses to pick them. It's actually, sometimes your intuition can be a powerful thing, but you've got to use it within the confines of a system. And if you do that, that means that you can make a decision knowing that your downside is limited to a degree you're comfortable with if you're wrong. And that is the main difference for me between 2009 and 2020.
Rob, would you mind spending a minute on
you're putting, just to save your reputation a little bit, like you're putting huge guardrails around your intuition. So I think that's well said, right? A lot of people should take away from that, much more systematic and a very small intuition with a very high confidence in your intuition, which leads to a very small adjustment in the systematic portfolio. So I think that's a great point. Sorry, Adam, over to you.
No, all good. I just was wondering if Rob, because you did work in the OPM industry for many years. And so I'm just wondering if you could sort of comment on the intuitive or opportunistic decision-making process through the prism of institutional fund management, right? Like if you're in, let's not use AHL because you work there, but if you're a large systematic institution, and having worked at those institutions, what did you observe in terms of that type of decision making, and what is your general thinking on the responsibility of the portfolio manager to be able to observe that there are things happening that the systems aren't aware of, but also operate within the limits of the offering memoranda and those types of things. Any thoughts there?
Yeah, it's a good point, because what I just did, if I'd done that at AHL, I would have been fired, and rightly so. The discretionary levers that you would be pulling would be more things like, how much should we allocate to this model? Should we turn this model on or off? Should we trade this market? In what size? A lot of those decisions will have quantitative underpinnings, but at the end of the day, it's often a human decision to actually call the final numbers. I think actually this is where potentially it's more difficult in an institutional environment, because there's a whole different set of pressures with other people's money that you don't have with your own, and things like, for example, year ends take on an importance that they don't really have for me. So wanting to get a good calendar year performance, I mean, certainly, and this is well known, I'm not giving you any secrets, but when I was working in an investment bank, if we were working on calendar years, if it got to November and you'd had a good year, you took no risk. I mean, you basically like hedged everything, like just completely hedged everything. And if a client came along with you tried to win no client business at all that would result in you taking any risk, because you've made your budget plus 5% that you're going to get paid. There's only downside from there. You just sit on that. And even in a systematic business, there is potentially the pressure there because if you've got looking at you've got obviously year-end numbers are in the report, and there are things like awards which rightly or wrongly have some currency as well, and they're often based on calendar year performance. So there would potentially be the temptation to reduce risk towards year-end potentially, and there are ways you can do that without actually, you can do it by. There are ways that you could do that potentially, and you're kind of in that big grey area between fully systematic and never touching anything and fully discretionary. And there is a big grey area there, and I think it's misleading to pretend that PMs don't have a degree of discretionary control. They can't control the position size. They can't do what I just did with my own money, but they can control a lot of levers that can result in things happening that would otherwise be the case. So I will tell you a story about somebody I know. And they were working at a fund, and I won't reveal the fund or the person's name or the name of the person they were speaking to, but basically they had a position on, and the someone came over and they were having a conversation about this position, and this person said, well, I think you should cut the risk on that position, and the guy said, well, that's reasonable to what level? And the guy said, until it's a short. Now, to me, that's crossing the line. I mean, the moment you're, it's one thing to say, oh, the model doesn't know about a particular risk, therefore this position is too big. We should reduce the size of this position. The moment you're changing the sign of the position, you've moved from risk management to basically, discretionary trading through the back door. So there's a clear line for me, but before that, there's probably a big grey area. Now, the other thing is that it's very difficult if, let's say, something's coming and everyone knows it. Let's take an example. Let's take the US election last year or Brexit. There's some big event in the calendar that's coming. Now, if you take no action, you don't make any overrides to your system at all. You just let the system do its thing, which is the pure thing you should do, and you then lose money. Your clients are going to come back to you and say, you had a fiduciary duty to look after my money. It was clear as this was going to happen. You shouldn't have let this happen. Now, Amen. For me, So for me, that's like, well, hang on a second. You're basically paying us to put money into a system. That means we shouldn't be doing this. Now, of course, if our fund had made money through Brexit, no one would have been complaining. Everyone would have been happy, and we'd be patted on the back, and we'd get awards and stuff. So there's that level of pressure as well. And even if clients don't say that to you, I think there's always that feeling in the back of your head, and perhaps there should be a feeling in the back of your head that this is somebody else's money, and you're going to be more risk averse potentially. And I don't mean just in terms of pure like economic utility of like choosing where your risk target should be. I mean, your behavior will be more risk averse than if it was potentially your own money and you didn't have that extra set of pressures.
Very interesting.
Yeah, that's really good.
Explaining it to somebody else is always a challenging dimension.
And I think also the fund management industry positions your role as you write an offering memorandum, and your responsibility is to execute on what you set out in the offering memorandum, right? But from the investor's perspective, while they technically bought a strategy that is described in the offering memorandum, the implicit purchase is, I want you to make me money, right? So it's not, I want you to run this strategy. It's, I want you to use your expertise to my benefit, right? And so there's an implicit sort of conflict, an agency conflict that is actually explicitly set out in the regulations of the investment business that I think is not widely recognized or discussed. Now you've spent,
and it's different from, say, the relationship, say, in a bank, working on a trading desk, because if you're working on a trading desk in a bank and you say make unexpected profits, you're going to be called up. Like they're going to be like saying, "What the hell are you doing? You've exceeded your risk limits." They're big, and that's because there's a much more, well, firstly, the contractual relationship is stronger, obviously, because they're paying you, and and so on. They have a lot of control and visibility over what you're doing, but also because there is that mutual understanding of why you're there, and it's a very, very clear relationship. I agree. I think with the fund management thing, it's much more difficult. It's like, do this, but don't lose money. Okay, well, what if those things are in conflict? And they sometimes are. What do I do? I can't predict the future. I don't know which option I should choose, and I'm always going to be taking a risk that I will lose you money if I do exactly what I should be doing. So yeah, I'm in complete agreement with that.
Yeah, that reminds me of Ted's comment of be the same but different.
Yeah, be the same.
Ted Sadie's was on last week at Capital Allocators, and one of the quotes from one of the portfolio managers is, "Clients want us to be the same but different."
Yeah, don't drift out of your style bucket, but make more money than the other guys. Yeah.
So Ted, there was one thing you mentioned on the discretionary side for systematic managers, and that was that a lot of the decisions are made on whether a system should be turned on or off, or a market should be taken off the roster or on the roster. I'm curious to know what that means from a discretionary perspective. Do they use data on it, or is it more like gut-based from the investment committee perspective? Because I've seen it in BlackRock, I've seen it in AHL. At least I've heard stories about all that. I'm curious to know what your experience there has been.
I mean, my opinion is any time, if you're working in a systematic business and you're making a decision and you're having to make qualitative judgments, you need to systematize that, right? Yeah. You should not be making, so in a good shop, and I'm probably allowed to say this, I think AHL is one of the better shops in this respect. The first time you make a decision, it might be very qualitative, but if that's a decision you're going to have to make, again, you should probably systematize it. And I'll give you an example. We were very worried in sort of 2011 about interest rates getting very, very low. Oh, how naive we were. And we were particularly worried about this weird phenomenon in kind of obscure parts of Europe, like Switzerland, where interest rates actually were getting very close to zero and possibly even negative. And we thought, well, how this clearly is. I mean, negative interest rates what is this magical mystery word? This makes no sense. Again, how naive we were. We had to make a judgment about whether to stop trading. I think it was the Euro Swiss LIBOR future, which was approaching a price of 100, which meant the rate was about to go below zero. So we had this kind of long discussions, and in the end, actually, I built a model basically which automatically reduced our position as interest rates approach zero in a particular market. And we had long debates about whether that limit should, where that threshold should be, whether it should be different for each market, because obviously in Japan, they'd had very low interest rates for a much longer period than in, say, the US. I decided that it should be kind of fixed for all countries, which is simpler as well as avoiding overfitting. And actually, in retrospect, was the right decision because, we've seen interest rates come down in the US as well to historically low levels. But then that was the important point here is that was now a system. It wasn't necessarily a piece of code. We didn't have to systematize it in that way, but it meant that if anyone had any discussion about whether we should turn a market off or reduce a position because of interest rates being very low, then we would say, well, we have this procedure in place. So if a client asked about it, we could say, well, we have this procedure in place. We have a system in place. So it's you'd no longer got a load of guys sitting around a table trying to make a discretionary decision, which could be subject to biases and so on and so forth. So you try and systematize it. So, I can think of many other examples. So for example, markets where volatility got very low, which has a couple of effects. Firstly, it means your leverage increases because we're volatility sizing our positions. Secondly, it means generally trading costs increase because the market's getting less volatile, but the tick size is not getting any smaller. So you're still paying the same spread. Risk adjusted, that spread is now much bigger and more. So it's a more costly market to trade. So you'd want to get out of those markets. Again, we the first time we had big kind of decisions about it. Then we put in place a system saying, right, the moment the volatility drops below this point, then we start cutting our position and we wait for it to go up to this level before we put it back in again. So that's how you can do it. I mean, obviously there are always going to be decisions coming up that are, non-systematic and, so they often relate to things that are not necessarily very market specific, like things like credit risk, maybe there's a market you can only trade with one. We had this issue there was a market we could only trade through MF Global. There were rumors on the street that MF Global were in trouble. Mr. Corzine was getting a bit candy with the gambling chips on the casino table. So we had to stop trading that market, and that that was not a quantitative decision. That was purely like, this is a very specific business risk because these guys are going down.
That's a great answer. Thank you.
Amazing, really.
So
lots of fantastic insights there.
Totally. I was wondering how much of the thinking that informs your strategies today was pulled very directly sort of from the general framework that you were using at AHL, right? Like, and or sort of, if that's a harder question to answer for, disclosure reasons, then maybe how has your thinking evolved since leaving AHL, and what sort of thinking are you applying today that maybe you weren't applying back then, and how do you do you have a framework for how to think about how your thinking should evolve over time in sort of in a way that reduces the amount of bias that you're bringing to the table?
Yeah. So in terms of my actual pure trading system, my futures trading system is not dissimilar from what AHL were running, certainly when I left. The main differences are there's no kind of proprietary signals in there. It's all stuff that is very well known on the street, pretty much. The sort of the long only stuff is obviously quite different in one respect, in that obviously it's long only, so you're doing a completely different, it's a different kind of setup. The commonalities are obviously around the idea of making forecasts. I think one thing that is in my system that a lot of people really find surprising is this idea of forecasts, a risk-adjusted forecast of future returns, which is something that's very much straight out of the AHL system and a very similar CTAs. So the idea is that you don't just take binary long-short positions. You're continuously adjusting your position depending on how strong a trend or a carry signal is. And the advantage of doing that way is it means you can use the same kind of thinking in a long-only system as well. So that's how I do my asset allocation, for example, long short that we were talking about earlier, when I'm not ignoring it, of course, because of COVID. So the kind of basic kind of theoretical building blocks, are things that I guess you could say I learned at AHL rather than sort of direct copies. I think the main difference is that I've tried to become much more rigorous in thinking about things like, I guess, uncertainty in terms of back tests and so on and so forth. So interestingly, so when I decided to leave AHL, the kind of conversation was, well, can you hang around for a bit as a bit of a handover? But on the other hand, we don't really, there's not really anything for you to do. So obviously there's a handover that takes a certain amount of time. You want clients to be handed over and make sure the clients are happy and make it clear this is not a kind of, this is a sort of very planned and gradual transition, and make sure it's all nice and smooth. But actually, in terms of what you're actually going to do, what do you want to do? So I came up with this project that was basically about doing conditional fitting. So normally when we fit our models, we look at all of history and treat it all equally. But one big question that was still around in 2013 was actually, how will CTAs do when interest rates rise? Because a lot of historic CTA performance has been in bonds, and actually just being long bond futures or long interest rate futures was a one-way bet. And a lot of the kind of Rorschach ratio was basically coming from the fact that there was an asset that was going up, we were long it, and that was all there was to it. What happens when that asset starts going down? Can you or should you fit your systems differently? And I think, Adam, actually last time we spoke, I did a blog article that basically did a similar kind of piece of research, and we talked about that a bit. So I won't go into too much detail about it. But the key point about this project was it really brought home to me how when people made very confident statements like, well, obviously, if interest rates are going to rise, then, trading fixed income with momentum is going to do badly. You should be doing something else instead. If you actually look to the data, it was so much uncertainty around let's fit a model that works when interest rates are falling. Let's fit another model when interest rates are rising. Yeah, there was some difference between them, and there were the patterns you would expect, but they weren't that different. And they weren't that different because there was still so much uncertainty there that these very confident predictions people were making were wrong. So what's always amused me is that people in the systematic industry, including myself, many, many times, spend most of their lives, working with statistics and data and having a much better understanding of statistical uncertainty than the average person, will then effectively make a point forecast and say, I'm 100% confident that you should turn off this model because interest rates are going to rise, for example. So the main difference in my thinking, and I think this has been helped a lot by the fact that I dare to say I don't have to speak to clients anymore, and I don't have to deal with that pressure, the OPM pressure that we've been talking about. It's allowed me to think much more clearly and honestly about how little I know, and to build my everything around my systems to reflect that. So, simple example is that if you're using something like, say, 12-month momentum to allocate between equities and bonds to tilt your allocation away from a strategic allocation of, say, 60-40, there are people out there who've written books saying you should go, 0 to 100 and back again, right? Not naming any names, but if you actually look at the amount of confidence and uncertainty that momentum signal gives you, it's nowhere near enough that you should be going from 0 to 100. You might be going at a push, be going from, say, 60-40, be going to 40-60 or 80-20, but no further. And that's a really simple example of how you should bring that uncertainty of, I call it the uncertainty of the past. Everyone worries about the uncertainty of the future, but actually there's a lot of uncertainty in the past because we measure things and we measure parameters and we test things, but actually, you do simple exercises like Monte Carlos and more sophisticated things, and you can see there's actually a huge amount of uncertainty in terms of what happened in the past. And you should use that. Otherwise, why are we here as systematic investors and systematic traders? Of course, you should use that information, but you've got to understand the limits of it and how far you can actually push yourself towards doing something very dramatic, bearing it, like turning off a model or like pushing your equity allocation to 100%, bearing in mind that not the future's uncertain, that's a given, but the past is also uncertain as well. And the COVID trade is a perfect example of that because, I made 2% on what was basically an absolutely perfect, almost perfect market call. I think I was 2 weeks late on the sell and I was 1 day early on the buy, and it made a difference to 2% of my portfolio because the amount of things I changed reflected the fact that I really had, I had a lot of uncertainty about what was going to happen in the future, but I had a lot of uncertainty also about how confident I could be about the predictions I was making.
That resonates really, really deeply with the learning trajectory I think that we've all experienced. And if you want to get a sense of what this looks like at home, and you've got even some simple trading systems, and we've run some simple examples, and I know you have too, Rob, but just try to, for example, take 5 trend following systems, and every year, based on the historical performance of the entire trading history up to that point, try to use any sort of statistical tools to determine which ones you should emphasize or de-emphasize going forward. And you'll just see that it is almost impossible, right? There's at the extreme limits, very, very short term or very, very long term, you might be able to sort of identify where some of the soft boundaries might be on those. But, you give up so much in diversification by trying to concentrate in the right one, and the information you have to make those decisions is just so weak that the realization currently dominates the precision. And I know you brought that to bear in your handcrafting process, which we really like. But I want to also dig into something because you kind of glossed over this in your in your last comments, which were great, but this whole idea of fitting a model, right? Like, say more about that, because there's so much that goes into that actually has a lot of discretion in how you think about fitting models. So how do you think about, so let's say you've got, I think you mentioned a 12-month momentum model or something, or pick one, doesn't really matter, but some sort of signal. How do you think about the model fitting process there?
I mean, one thing that is interesting is that I think people have the impression that model fitting is something that should be automated, right? I mean, the whole kind of machine learning sort of drive is that you know, really you should just be able to press a button and the parameters come out at the bottom and it's all good. And I'm very much against that. So the first thing to say, I guess, is ideally you should keep your model away from the data for as long as possible. So the moment you actually, the most tempting thing in the world is to, I've got a new idea, I've got some data, I'm going to test it and see if I've made money or not. That is literally the last thing you should do. Because the moment you've done that, you're going to be opening yourself up to what I call implicit fitting, which is basically where you've got an account curve, it doesn't look good, you say, oh, I won't do that. Well, you've basically made a fitting decision, but you've not made a fitting decision in a controlled way. You've done it in an uncontrolled way, and it's effectively an in-sample fit. So you want to push that decision off as far into the future as possible. So the first thing I do actually is focus more on the behavior of the model rather than on the profitability. So I'll be looking at things like, does this model capture the effect I want it to capture? Are the trading costs reasonable? Does the holding period reflect the sort of effect that I'm trying to capture? So, for example, if I've got a model that's trading every day, but it's looking for 6-month trends, well, that suggests that some kind of smoothing would be in order before continuing. And what I will do is one of two things. I can either, if appropriate, I'll use data that's completely random to make those kinds of decisions. And it may be not completely random, but for example, I might actually create data that has trends in it, like 6-month trends up and down, plus some noise. And it's completely unrealistic, but it can allow me to answer the question, well, does this capture 6-month trends? Because look, here's a 6-month trend. Is it capturing that trend? Yes or no? So that's the basic thing, because it's very easy to construct something that doesn't do what you expect it to do. The other thing, if I can't do that, it's not always possible, I will use real data, but I will limit myself to a single market, and I won't be looking at profitability. I will be looking at, I might take a 5-year snapshot of a single market, and I'll just look at the buying and selling behavior, the holding period, and sort of make sure that that's doing what I expect it to do. Now, then what I want to do is to, once I'm happy with the model's behavior, I then want to see whether it's any good or not. But I won't test the thing independently. I'll just drop it into basically a massive portfolio optimization with all the other signals I've got. And what that will do is it will then effectively allocate some risk capital to that model. And obviously, if it's a good model, then the risk capital will be high at the end of the backtesting period. And if it's low, then obviously it's a poor model. And if it's below a certain threshold, there's not really any point implementing it, because if you've got, say, 50 models and average of 2% risk capital, well, if one of them ends up with 0.01% because it's so shockingly poor, then there's no point in implementing it, and you're not going to be achieving anything. You're just going to be writing code for the sake of it. Now, the important thing is that decision as to how much risk capital to put into something is not based on me looking at an account curve. It's based on a fitting process which is controlled, and that means I can do two things. Firstly, I can make sure that it's robust, and it's allowing for the amount of uncertainty in the data, which, and as I've talked about, that's much bigger than you think it is. And secondly, it can be a purely backward-looking thing with no in-sample information polluting it. Now, the reason I can do this is because my models are all structured effectively as linear-weighted combinations. So, I've got lots of Lego building blocks. I combine them in linear weights using a robust portfolio optimization process. And that means that the actual resulting behavior can actually be quite complex, but it's made up of things that individually are quite simple. So none of my individual models are complicated. They're all pretty simple. And actually, if you follow my blog, there's a lot of things where I'm posting something saying, oh, look, this is interesting, but it's going to make my model too complicated, so I'm not going to bother doing it. You know, so it's like I'm constantly I spend a lot of my research time looking at things and deciding that this is not actually, it makes a small but insignificant difference to my performance that's not worth the complexity that it adds. So that's kind of the way I'm thinking. I will only add something if it adds something to my performance, if there's a good thesis behind it. So it's not just a pure data mining exercise that's pulled something out that seems to work and I have no idea why. I believe that can work, but you need to be much, much better at machine learning than I am. And it also needs to be something that I can implement in a relatively simple way without making my system, for example, horrifically nonlinear.
So walk me through the optimization a little bit, because I think I know a little bit about what goes on, right? I think you've got a regularization step where you are sort of taking each year independently, and then what you want to do is sort of maximize the average performance relative to the dispersion of the performance from like calendar year to calendar year, I think was one of the techniques that you were applying, or did I miss?
The expression on my face thing is maybe you've got me mixed up with somebody else.
It's funny because I've got this secondhand, because one of our internal quants was using a strategy that was informed by your systematic investing book when he first joined us, and so he sort of walked us through the handcrafting that he had been doing, and that's what I took from that. So
so this handcrafting is so what I noticed when I actually watched how people actually fitted portfolios. This was a kind of an anthropological observation. Everyone said that they fitted portfolios using some kind of fancy optimization process. And I remember very clearly the first time I watched somebody actually do this. There's a guy called Simon. So Simon, if you're listening or watching, hi Simon. I hope you won't mind me using your name in the story. But Simon, who was a much more experienced researcher than me, we implemented a new model. But Simon was the guy on the team that was responsible for allocating the portfolio weights to different instruments within our model. So that was his job. So he sat down and ran this optimization. Of course, it came out with, there were like 20 instruments, and 2 had a weight of 10%, the rest was 0, as you might expect. I sort of looked surprised, and Simon said, "It's okay, Rob. Optimization is an art, not a science. Go and get yourself a cup of coffee, and when you come back, all will be well." I came back, and there were this beautiful set of weights. And what Simon had done was basically added constraints to the portfolio until the weights looked like he thought what they should look like. And there's no disrespect to Simon specifically, because I know loads of people who do exactly the same thing and probably still do it now. And I've done it myself. Now, I thought, well, this is crazy. Why don't we if we're going to just put in portfolio weights that we think look right, well, let's just do that. But let's try and do that in a robust way. So if you actually have intuition about how portfolios should be optimized, well, the first thing you do generally as a human being is you put things into groups. So you say, well, I'm going to put all my bonds over here and all my equities over here, and I'm going to decide my top-down risk allocation. That's the first decision I have to make. And the nice thing about that is from a mathematical point of view, by separating that into effectively 3 problems, a kind of how much in A, how much in B, and then how much within A and within B, those problems individually are much easier than the problem of doing A and B jointly. So effectively, you end up with a hierarchical approach, and this is quite commonly used. So there's the HRP, hierarchical risk parity, which is the kind of the more sort of high-end version of what I do, I guess you could say, coming from more of a mathematical background rather than me with my anthropological kind of observation. So the first thing you do is cluster. And then within each of those clusters, obviously, you work down until you're at the point where you have a cluster small enough that you can allocate within that cluster in a robust way. And actually, I used to use clusters of 3, and now I'm down to clusters of 2. And basically, you allocate within a cluster, you give 50% risk weight to each asset. because that's the optimal portfolio weight. If volatilities are the same and Sharpe ratios are the same, everything should get 50-50. The next step then is to say, well, actually, if you do that, unless you've got you're very lucky, you're going to have bits of your portfolio where you're not going to have, you don't have equal risk weights when you should have equal risk weights. So, for example, suppose you've got the same number of bonds and equities, but your equity markets are much more diversifying than your bond markets, then you'll have less risk effectively than you should do between those two asset classes. So there's a correction I do, which is called the diversification multiplier, and it's just the inverse of the weight, the sort of outer product of the portfolio weights. And basically, if you've got two assets that are uncorrelated, then their diversification multiplier is going to be 1.41, which is the square root of 2. If you've got two assets that are perfectly correlated, diversification multiplier will be 1. So you multiply all your weights by these numbers, and that effectively then gives you equal risk allocations, all the things being equal. And then you can then apply a couple of overlays, and one is basically Sharpe ratios to say, well, actually, I've got information about Sharpe ratios, so I'm going to use that to tilt the weights. And it is tilting. It's not, like we've said, it's not going 0 to 100, it's tilting. And basically, to do that, I use a kind of a little bit of maths, which relates to the sampling uncertainty of the Sharpe ratio. There's a paper by Andrew Lowe, like 25 years ago, that introduces this quite simple formula. And I use that to reflect both if two assets have different Sharpe ratios, but say I've only got a year of data, those weights are not going to move at all. But if those two assets have got very big difference in Sharpe ratios, and also if they're uncorrelated, which means that difference is more significant theoretically, and I've got 50 years of data, well, it's quite plausible that can make quite a big difference in the weights. And this is all being done in a kind of assumption that all assets have equal volatility, which in my futures world is correct, but in my long only world is not correct because I don't use leverage. So then I'd apply a fairly simple stage which maps from risk weights to cash weights. So that's kind of where, and it's evolved over the last few years. Actually, the methodology, I made it more robust. I've changed a few things, like just making it two assets, and made a few simplifications, but it's not that dissimilar from the HRP, but there's a few twists in there.
Yeah, it's sort of like robust risk parity times the probabilistic Sharpe ratio.
Yeah, exactly. Yeah. So in a theory, so one thing, one lesson I like to talk a lot about is about uncertainty, because people have different views on uncertainty in markets. I was having a debate on Twitter with some trend followers, because I'm kind of we're in this weird position where I'm on the edge of the trend following community, and they invite me to talk on their podcasts and stuff, but we disagree on a lot of things. And they make this statement, well, the good thing about trend following is you're not making predictions, which I disagree with, but that's another discussion. This, Jerry Parker, who's this kind of big CTA guy, came on and said, well, Rob, I won't try and do his accent. The reason why we don't make predictions, I'm like, you do. The reason why we don't make predictions is because markets are very uncertain. Yes, they are uncertain, but importantly, there are different degrees of uncertainty. And if you think about the three statistics you need when doing portfolio optimization, which is mean, standard deviation, and correlation. Actually, let's change that and say Sharpe ratio, standard deviation, and correlation. Standard deviations are very predictable, relatively speaking. If you regress, say, next month's standard deviation on last month's, you get an R squared of about 0.25, which in finance is an amazing R squared for a regression. Anyone who's listening knows about R squares and regressions. That means that's very, very predictable indeed. So that means you should why things like risk parity are a good idea is because actually volatility is quite predictable. And that's even without doing anything fancy like using implied option vol or the VIX as a secondary indicator, or using a fancy Garch model or anything like that. Correlations are a little bit less predictable, and that's why using this hierarchical structure is a good idea, because that brings in robustness and means you don't do things like, if you have two assets, say, that are very highly correlated normally, portfolio optimization will do crazy things with those normally, because it's not accounting for the fact that those correlations aren't always going to be that level, and when they break down, that's when you end up often with people losing a lot of money. And the thing that's least unpredictable of all is Sharpe ratio, which kind of makes sense, right? Because if you can predict Sharpe ratio, you'll be extremely wealthy. predicting standard deviation just means you're less likely to go bust. It won't make you rich, sadly. Predicting Sharpe ratio is very hard, and that means any predictions you have about Sharpe ratio should not be affecting your portfolio as much. You shouldn't be putting as much into them, which is why I have this probabilistic layer in there, as you say. So basically, what my thing does is assume I can predict standard deviations perfectly, because I do risk a straight mapping from cash weights to risk weights. Sorry, the other way around. Assuming I can predict them perfectly, it assumes there is some difficulty predicting correlation, so I have got a robust structure in there to deal with that, and then I assume that predicting Sharpe ratios is really hard, so I have a full kind of layer of probabilistic uncertainty in there to reflect that. So it's reflecting those 3 degrees of uncertainty. Whereas, if you just take a naive Markowitz out of the box portfolio optimization, it doesn't know anything about uncertainty. It takes all the forecasts, point forecasts, assume there's no uncertainty in them at all. So it's a more nuanced approach.
Well, yeah, I mean, we're obviously huge supporters of that type of probabilistic based optimization and robust optimization. I was curious whether you've run any, well, I suspect you have. What do you observe when you run your optimization on, so this is at the total portfolio level that includes your probabilistic Sharpe estimates. Have you walked that process forward and observed how the relationship between your estimated probabilistic Sharpe ratio weights and the realized probabilistic Sharpe ratio weights? And do you observe that those relationships are meaningfully persistent over time?
I haven't exactly done that. One thing I have done is with all 3 of these kinds of statistics, I've done things like saying, well, how does the R squared change with how much data, with how much time you've got, and things like that. What I have done, for example, is say, well, let's take momentum. I've said, well, as a way of illustrating actually the uncertainty. So if you had no information about anything, you'd basically just use unconditional estimates. And in fact, you probably, for Sharpe ratios, you wouldn't even bother using them. But you basically, if you get some kind of unconditional distribution for Sharpe ratios, it has some certain shape. If you've got a really good indicator, let's say that splits into, I think, high or low states for momentum, say something like that, you still end up with distributions, and they overlap a little bit, and that overlap's telling you actually, you don't pull the handle completely. This is about tilting your portfolio depending on the Sharpe ratio. But there is some information there, because obviously there's no information that the 2 conditional distributions will sit on top of each other and you wouldn't be able to see any difference between them. So I've done that. The difficulty with doing what you describe is there is so much noise that if you're doing really, really well, you can make us, the predictability in Sharpe ratios goes from an R squared of like 0.03, which is just noise, to like 0.07. It's still a very, very, you're still not doing a great job of predicting Sharpe ratios, but you only have to do a little bit better than the unconditional noise to have quite a decent portfolio return. So no, I haven't done that. It would be an interesting thing to do though. But I suspect it would be quite hard to see much there. I mean, the statistics would be meaningful, but I'm not sure that there would be enough of a pattern there to make it a compelling picture to look at.
Well, yeah, I mean, I think we've sort of concluded that actually is the hardest and most rewarding effort in finance.
Those 2 things go together, right?
Yeah, right, absolutely. And I mean, it is just shockingly hard. I mean, we don't really use the linear models so much anymore, but even if just using, like, really constraining the degrees of freedom in your models and having a small number of models for each sort of, call it, feature family, right? So you've got a few carry models, and you got a few seasonality models, and you got a few trend/momentum models, and you're gonna use 90% of the data and derive a probabilistically weighted expectation of future Sharpe ratio for the remaining 10%. and use a variety of different objectives or target metrics to determine your optimal weights. And even using 90% of your data, and some of this futures data, is obviously goes back to the sort of mid 70s, to make those predictions, the R squareds are just vanishingly close, small delta between 0.5 and the realization, right? And so it ends up you've got to sort of drill deeper into the for example, stuff like the stability of the models through time. And then you got to have like nested versions of these validation procedures in order to figure out the right balance between, trying to be precise versus trying to be robust. And like this is an almost endless rabbit hole, right? That so I think the lesson is, unless you want to spend all your time on this problem, which again, admittedly, is the most rewarding problem in finance, being extremely humble about your ability to make strong tilts in that dimension is probably your best course of action.
I mean, this is what I find interesting, because I think a lot of people pay attention to things that they ignore things that are easy. Like, it's easy to predict standard deviations, which means, for example, that and we've talked about this before, risk parity should kind of be your starting point. And people dismiss that because they say things like, oh, well, you shouldn't invest in risk parity because, that means you'll be putting too much of your portfolio in bonds, and everyone knows bonds are going to do badly, which is basically making a point forecast with no knowledge or understanding of probabilisticness in at all. So they're saying you should ignore this very predictable thing, which is standard deviations, while simultaneously saying that there is a very large predictability in Sharpe ratios, because everybody knows that this is what's going to happen to bond and equity prices. And I mean, yeah, sure, bonds look expensive now, but they looked expensive 8 years ago, but risk parity's done okay. So, I'm not saying that risk parity is necessarily a great buy right now, but the point is that the structure of thinking that I like to use based on evidence around predictability leads you to really question a lot of the things that people say about these things.
Well, it's a Dunning-Kruger effect in full flight, right? Like the Dunning-Kruger effect is one where somebody comes into the market, they see a nice little trigger, and they're like, I'm going to do 100% of that. So I'm either 100% in equities, as you said earlier, or 100% in bonds, or 100% in commodities. As you start digging deeper, 100% in GameStop. And as you dig deeper, you're like, oh, I didn't know that. That's not going to work out for me every time. Maybe I shouldn't do 100%. And you go from 100, trying to predict the future prices or Sharpe ratios, to saying, well, hold on a second, what's easy? You go down to correlations, then you go down to volatility, and then you realize, okay, we should actually start with risk parity. Start with that base case, because that's the one we have most confidence in, and then slowly build and tilt after that. So it just takes a decade, a lifetime, and a professional lifetime to go from being 100% certain to not being certain about anything at all, and using a probabilistic method.
And the other thing that's kind of related, not exactly the same in terms of things that are easy, is risk premia. Like, doesn't require any skill to collect risk premia. Maybe requires a certain amount of operational things you've got to do to understand, and you've got to maybe do things like short stocks, which you can't do very easily. A lot of these things you can do through ETFs now anyway. But just collecting risk premia. I mean, people say to me, what's your skill? I'm like, skill? I'm not sure I've got any skill. I collect a bunch of risk premia. I try and do it in such a way that, in a robust way, which means I'm not making silly mistakes like paying too much for execution or overfitting my models. But, a large percentage of my returns is just collecting risk premia. There may be a tiny amount of something special in there, but it's a much smaller proportion than most people realize.
And I think the other thing that's missed is the idea or the understanding that when you've taken those lower building blocks that you have higher confidence in, and you've built a maximally diversified portfolio, when you tilt the portfolio, you are likely increasing the standard deviation of the portfolio, and you have to be more right, because you've imparted this tilt, and that tilt takes away from the diversification. So the least likely thing that you believe you can predict, i.e. Sharpe ratio, you have to have a really high confidence in that, because you're giving up the other two layers. And I think that's just absolutely lost. People don't understand. And this is kind of the core idea of you start with risk parity. And once you understand this maximally diversified portfolio and you lever it up to whatever risk that you can tolerate, when you step away from that, you are embedding a prediction of a Sharpe ratio, which you have a much lower confidence in than the other components of inputs for the portfolio. And it's a higher hurdle than people think.
That's right. I think people think they're layering returns, right? They think, okay, I start with my base case and then I'm going to layer this return. But what's actually happening is you're taking away the rebalance premium, where we talk a lot. And so you're adding an expected
diversity
return with less. Yeah, the diversity, which leads to the rebalance premium. Yep. You're taking away from this. And what you're adding needs to be, the hurdle is what you're taking away. So you're not layering anything. You're losing something, and you'd better be gaining something really big to do better than the base case.
I mean, it goes back to the very first discussion we had, where I said, well, like, you take some of your portfolio and you use that for, say, opportunistic stuff, what have you. Well, the kind of hurdle rate on that is not zero. It's what you would have made, is what you expect to make on what you've already got. So you need to be very convinced, as you say, you need to be very convinced that this is absolutely the right thing to do. And that's why, and that knowledge that this is quite different. What I'm about to do is going to be quite hard to get right, is what should make you say, well, I'm not going to put 100% of my portfolio into this crazy thing. I'm going to put this much in because because I know I'm pretty confident this is a good idea. I'm confident enough I'm going to do some of this, but I'm no means arrogant enough to think that I can take 100% of my portfolio. I'm going to limit it to 5% or 10% or whatever. And I mean, there's a lot of jargon in the investment industry that kind of is confusing, misleading. And I mean, you guys are old enough to remember this idea of core and satellite, which it's kind of gone out of fashion now. But there was some kind of that actually I found quite a helpful way of thinking about the world. Like, basically, you start with this, and what we can have, and you obviously, what we start with, we have a big debate about, and then you do a bit of this on top, and again we can have a bit of a debate about that. But it's a different approach from, as you say, the idea of layering things up. I mean, I remember a discussion I had with somebody during the last market crash, and the guy said, well, you know, I'm no idea what's going to happen, so I've gone 100% into cash. I'm like, well, that's a huge decision. You're making a huge. You're actually making a
confident expression in what's going to happen.
You have actually made a much bigger decision, a much bigger statement about what you think is going to happen than I have. Going for, I think I going to say 50% cash or whatever at the time.
And then you said, if instead of cash, you should buy 100% Bitcoin, right?
Well, this is the point I was trying to make earlier on when you were talking about those subtle changes you had made in the portfolio in March 2020, right? They were subtle, and they absolutely understood the trade-offs that we're talking about now. And they understood that you understood the humility with which you need to think about those outside tilts. And that's, I think that point can't be emphasized enough, I think, as we view.
So I guess you've got the systems trading that embodies the idea of uncertainty in this way we've described. And then the kind of, as I said, the main evolution in my thinking has been the fact that I now apply the same level of understanding of uncertainty to the kind of meta part, which is actually in terms of how I design the system and how I backtest it. So it's not just that I have a system that embodies the fact that the world is uncertainty and there's different levels of uncertainty, and you go with the things you can predict the most. But I also similarly, try, and more so than when I was working for AHL, actually, if I've had any evolution, it's that I apply that skepticism and uncertainty to the actual process of constructing these things as well, in a much greater way, I'd say. Hopefully,
and you went over sort of asset class inclusion, and we didn't dig into that too deeply, but I wouldn't mind doing that now in the context of Rodrigo mentioned the evil word Bitcoin. But how, it's $1 trillion asset class now, but maybe that's a good example or a bad example, but how long, or how do you think about asset class inclusion at the, sort of the first level? And when it comes to new assets that might impart some different exposure to some other risk that you would be hedging by buying that particular asset. How do you think about inclusion? When does something qualify? How long does it take? Because you talked about having something that only has a year history. Well, how do you know anything about that asset class? So you can talk a little bit about that, the asset class inclusion side, and what are the sort of hurdles that have to be overcome for inclusion.
I mean, it's a difficult one, and because actually my portfolio is relatively simple in that it effectively only has 3 asset classes in it. It's got bonds, equities, and then it's got this futures trend following account, which I kind of treat as an asset. And because that account has within it, say, commodities, it's kind of picking up things that other people might want to get through, for example, buying commodity ETFs, which was the fashion 10 years ago, less so now perhaps. So there are things that aren't in my portfolio, like, for example, there's things like private equity aren't in my portfolio. Things like, I mean, generally speaking, there are quite a few asset classes that I would not mind accessing, but the sort of costs of doing so, which could be something as simple as doing it through a closed-end fund, they tend to have quite high charges. So one of the things I talk about a lot in my Smart Portfolios book was this very difficult thing where there are quite a few things that look good, but actually to a retail investor, unless you've got a lot of money and you're able to do things like directly invest in, say, 10 private equity funds, which, to get diversification, because just putting your money into one private equity fund for me would be just too risky. So you need quite large amounts of money to be at the stage where you can write 10 checks to private equity funds. So you then, okay, well, what do? I'll go via the ETF route. Well, it's great the ETF route's available now, but then you look at the AERs on these things, and they're the kind of 10s or even over 100 basis points, and you think, well, am I really going to generate enough marginal improvements in my portfolio to justify that? And the other thing is that I think that there is a case to be made that if you do have some, let's say you knew nothing about private equity or nothing about anything at all, well then, and you can afford to, then yeah, absolutely have as many, in theory, I mean, we can get into details about things like Bitcoin, but in theory, have all these things in your portfolio, have a bit of commercial property, have a bit of private equity, have a bit of this, have a bit of that. By all means, that is theoretically the best thing to do. But I'm in a slightly different position in that I know quite a lot about this weird asset class called futures trading, and I can invest in that without paying any fees. I don't have to pay some guy 2 and 20 to invest in that. I can get it for the marginal cost of my time, which works out to less than 2 and 20. And especially when the system's running and just running by itself, right? And I can't, if I look at my performance over, say, 7 years, which isn't really long enough to be statistically significant, but long enough to kind of start making a judgment, I'm kind of ahead of the benchmarks, but a bit behind the top I'm sort of at the bottom edge of the top quartile, say. So it makes more sense for me to, on a marginal basis, put my kind of alternative asset allocation, if you like, into that, rather than to sort of, put $10,000 in a private equity ETF, for example, or something like that. Now, if I had a lot more money than I do, then maybe, yeah, I would consider investing directly in private equity, but it doesn't make any sense for me at the moment. In terms of history, I don't think that's that important because, okay, the nice thing about the process I've just identified to you is, okay, volatility. So I need a month's worth of data. If something's been trading for a month, that's enough for me to predict its volatility. So I'm happy. And in fact, even then, you can probably, if you said to me, what's the volatility of this Turkish equity ETF? I'm going to guess about 30%. Because it's an emerging market ETF, equity ETF. And I may be wrong. I'm not going to be wrong by a factor of 2, though. I might be wrong by, it may be between 20 and 40. Maybe it's a bit higher because Turkey's quite interesting at the moment. But I'm not going to be wrong enough that the position is going to be way out of line. So and because of diversification, because that Turkish ETF is going to be ultimately a small part of my portfolio, there's less kind of idiosyncratic risk in making the decision and putting it in and potentially getting that wrong. So actually, that doesn't bother me. And the nice thing about the sort of probabilistic Sharpe ratio idea is actually it accounts for the fact there's not much data automatically. It says, well, you've only got a month of data. Well, that the fact that this thing may have done amazingly well in that month is kind of nice, but actually it's only going to tilt the allocation by a fraction of a basis point, because it's statistically meaningless. And then for correlation, I mean, I tend to find that about correlation predictability peaks at around 6 months, say, but ish. I mean, a bit longer is nice, a bit longer, a bit shorter does not make much difference. So, but again, you can probably guess roughly what the correlation of that thing is going to be with everything else as well. I mean, it's going to be quite correlated with other emerging market equities, maybe a bit correlated with Turkish bonds. I mean, so you don't need very precise. This is one of the kind of things that's a bit weird. You don't really need very precise estimates of these things, because your portfolio process should be robust enough that actually it's not sensitive. I'd be really worried actually if I had my Turkish ETF with 1 month of data and the allocation was here. If after 2 months the allocation was here, I'd be like, well, there's something wrong with your system. There's something wrong with the way you're allocating risk.
Rob, I'd love to get, because we're closing in on an hour and a half, and I'd love to leave listeners with something. With there's lots of practical stuff here, but something really concrete. And I'm just curious, if you were not, I mean, you obviously have the ability to trade your own accounts, and you have been doing so for many years, and you've been using strategies that you fundamentally believe in. If you did not have the ability to trade your own accounts, how would you think about setting criteria for decision making for allocating to other investors or firms or funds or whatever that would raise the probability of success for you?
Yeah, I mean, so in this hypothetical world, do I still have all the knowledge, skills, and experience I've currently got?
Let's assume you do, but you just don't. Okay. For some reason, you don't want to run your own accounts.
Yeah, I mean, I'd probably. I'd only go with fun. I mean, this is the interesting thing, because actually my decision-making process would probably be quite qualitative, because of my limit. For example, if you showed me a manager with a great track record over, say, 5 years, well, the statistical part of my brain's going, yeah, that's good, but it's probably not statistically significant. Okay, so I would potentially, if you showed me a manager who was supposed to be doing something, and actually his correlation with the benchmark was 0.2, I'd be like, oh, well, that's a bit suspicious. There's a lot of style drift there. There's something a bit strange going on here. If you showed me a manager whose Sharpe ratio was exceptional, I wouldn't even consider him, because most likely probability is the next Bernie Madoff. May he rest in peace, wherever he's gone, up or down. So there would be a limited amount of kind of quantitative information that would be, in that decision, but actually less than you might think. It would be much more. I would probably only invest in funds whose business model I understood, and where I had a high degree of empathy with what they were doing, and that potentially would actually mean a less diversified portfolio than maybe you would expect, because actually I probably still have quite a big allocation to CTAs, even though, because I understand that business, and I can read a prospectus and talk to people and get that qualitative information. And I don't see the point of not using the skills and knowledge and understanding I have of that, say. But I would be less likely to invest in a discretionary long-only equity manager, because A, it's not a space I understand, and B, I'm more skeptical about whether they're really adding value beyond their fees that I couldn't just pick up through buying into the risk premium, value premium, things like that. So yeah, it's not a very kind of, these are the equations and calculations I would do.
I actually think it aligns with what I believe investors do anyway, which is you align with managers that align with your values. And I think the reason that works is because if you have similar values and you understand that process better, that you're more likely to stick to those managers through the thick and the thin, because there's a shared belief system there. And so, yeah, it totally makes sense to me that you would be more geared towards CTAs and tactical asset allocation, or core and explore. right? And then from there, it's just the pedigree and the reputation of the managers that you end up interviewing. And value investors do the same thing, and momentum investors do the same thing, and they call each other out and say value investing is garbage. It's just, at the end of the day, I think the majority of single investor alpha is their stick-to-itness, and that's really most of it.
But don't take from this that because I think a lot of the problem with people is that they are. And that's naturally like a sales thing. Like if you work in the CTA industry, of course, you're going to say to people, you should have a high allocation to CTAs and trend following is the best strategy and all this kind of stuff. But you should have a diversified portfolio of risk premia and that means you should still have allocations to equities and bonds. You still have allocation to value. You should still have allocation to momentum, yes, but also to things like carry and some negative skew stuff that's going to be a nice kind of counterbalance to the positive skew of momentum. I think that the main difference between me now and me in this imaginary world where maybe I've retired and I can't be bothered to run the futures portfolio anymore is that the asset allocation is probably going to not look that different, but it may be actually more diversified because I may be a bit more adventurous and have a few different types of funds to replace that kind of allocation to futures now, which obviously wouldn't exist in the future. I wouldn't just do a straight swap and sell. Sorry to my former employers, but I wouldn't just get rid of that and buy AHL. I think it would be an opportunity to diversify that a bit more, definitely.
Nice,
excellent,
thank you. All right. Well, we're over an hour and a half in, and Rob, it's getting late. What is it like? You're sneaking up on 5 there now on a Friday afternoon?
Yeah, it's getting up to beer o'clock, definitely.
Yeah.
Sorry to you guys who are like, a bit earlier in the working day still, but yeah.
Well, we do that to people on the West Coast too, right? So we often have guests on and so we're drinking, and it's still close to noon their time, and they're envious, so it's the same. Anyway, this has been absolutely magnificent. I'm really grateful for your time and your usual candor and humility. And I'm sure everybody learned a lot. And hopefully we can do this again sometime.
Definitely. It's been a lot of fun.
Thanks, Rob.
Thank you very much.
Been a delight.
Thank you, Rob.
Thanks, guys. See ya.
This episode is brought to you by Resolve Asset Management Inc.'s separately managed accounts, available for U.S. and Canadian investors. While diversification is often discussed, it is important that it actually be delivered. Through the suite of Resolve global mandates offered at varying risk levels, we aim to strike the balance between global diversification, appropriate risk balance, and directional alpha. Our portfolios are designed to safeguard and profit across many economic regimes, including periods of negative growth shocks or unexpected rising inflation, periods in which, in our view, the traditional 60-40 portfolios may fail to deliver adequate returns for investors. Resolve to improve your portfolio. Click on the link in the description to reach out to a representative and assess which Resolve mandate is right for you.